Good evening, everyone. Welcome back to another session of ratio analysis. In the last class, we have gone through some interesting ratios which help us in analyzing the financial health of a company. We have seen some of the basic ratios as basic as like current ratio, quick ratio, uh, absolute liquid ratio, cash ratio. We've also seen some of the return ratios in which we saw return on capital employed, return on net assets, return on equity. We've also gone through some of our market related ratios like earnings per share, dividend per share, dividend payout ratio, price to earnings ratio. So we have been through bit of these ratios. We are left with some more ratios for today's session. So let's just go ahead and discuss some more ratios, and then we'll be proceeding for the questions that we have in the module. Plus, we'll be also providing you some additional questions for practice also. So here's the first question from my end on you. So we start our today's session with the question that since we have seen the short-term and long-term solvency, we also need to check the efficiency of a company with regards to how well the company is utilizing its assets, how well a typical company or a business entity is utilizing its assets to the best possible extent. And for that purpose, we have a certain set of ratios we looked into. How do we know whether a company is really utilizing its assets or the investments in the best possible manner? For that, we are going to look into a set of ratios called as a turnover ratios. Okay, so those turnover ratios are some of the turnover ratios are placed on the screen. We have to fill up the blanks basically. So all of the name, you can say they are all named as like turnover ratios. So does it have something to do with turnover or does it have something to do with the sales? Yes, it has, because we're going to see how effectively we are able to generate uh, sales by using our assets. So these ratios are also called as efficiency ratios. These ratios are also called as activity ratios. So general notation, we say, how are we really going to uh, measure the efficiency or measure the activity level of any company? These turnover ratios are going to be a guide for us. So coming to turnover ratios, our objective is how well we are able to utilize those assets or utilize the capital for the purpose of generating sales or maybe something related to that asset. It can be COGS. Right? So let's come to the first basic, we can say, first ratio, which is total asset turnover ratio. Total asset turnover ratio. When we say about the total asset turnover ratio, it means we want to know how effectively we are utilizing our assets for generating sales. So let's say, just an example. Suppose there is a company A, there's another company B. Company A is having a sales of 1 lakh. Company B is also having a sales of 1 lakh. So which company is generating good sales? We'll say both of them are same because sale amount is same. But if I say that company A has a total asset base of, let's say, 50,000, Company B is having a asset base of 20,000. So any common man can say that with the available level of assets, considering both of them are into the same industry, uh, considering the level of assets that they have got, any person will say, sir, company B is effectively utilizing its resources because uh, with a asset base of 20,000, it's able to generate a sales of 1 lakh, which is definitely a good thing. Whereas when you see company A, it is having a higher asset amount, but on the other hand, it is able to generate the same 1 lakh sales. So somewhere we are going to connect the sales and the total assets. So with a lesser level of total assets, if we are able to generate higher quantum of sales, that indicates that we are really doing good use of our resources. So with the available resources, we are able to generate really good quantum of sales. So ideally, if I ask you, so what makes the company A to be a better in terms of activity? Any person will say, sir, company B is able to generate 5 times of its total assets as sales, whereas company A is able to generate 2 times of its assets as sales. So basically, company B is able to generate sales which is 5 times of its sales. A is able to generate just twice of the assets as sales. So it means more effective utilization of resources is being undertaken by definitely company B. Okay. So company B is definitely utilizing the assets to the best possible manner. So that's how we are going to measure the total assets turnover ratio. I hope some of you might have even understood how we are going to calculate it. The term which I said that it is generating 5 times of its total assets, or company A is generating 2 times of its total assets. That's the same what we say as a total asset turnover ratio. The total asset turnover, if I ask you, sir, how did you get this 5 times or how did you get this 2 times? The simple answer would be it will be 1 lakh divided by 20,000. In case of A, it is 1 lakh divided by 50,000. So what was that 1 lakh? Sales. What was 50,000? Total assets. So what was 20,000? It was 20,000. So what was 20,000? That the total assets. So when we say total assets turnover, we are going to see how many times of our assets are we able to generate the sales. So total asset turnover ratio, we say it is calculated as numerator, you should be having sales, whereas in the denominator, it should be total assets. Should be total assets. So mind it, it's the total of all the assets, right? So it's not net assets, or you can say the total assets minus net assets minus liabilities. It's the value of total assets with the available asset base, how much sales you are able to generate. Sometimes instead of sale, we also consider cost of goods sales or cost of goods sold. We also use this cost of goods sold as a number, as a numerator. It somewhat connects us because the sales includes the element of profit, whereas when you say cost of goods sold, it doesn't include any element of profit into it. It doesn't include any element of profit. It's just the cost. So with the available assets, how much quantum of sales you are able to generate, instead of considering the profit also, we just remove the profit and we just consider the cost component of it. Then as we look into the fixed asset turnover, uh, any one of you can guess it, what it can be. The numerator remains same, which is sales upon sales or cost of goods sold upon fixed assets, or I can say fixed assets. So this ratio helps us to evaluate effectively which of the companies are really utilizing their fixed assets in the best possible manner, or which companies are able to attain a higher degree of activity with regards to the fixed assets that they are having in their entity. Coming to the capital asset turnover ratio, sorry, capital turnover ratio. When we say capital turnover, we mean to say how effectively we are utilizing our resources, we are utilizing our capital that is employed. So capital turnover ratio, as you would be saying, so numerator has to be same. Yes, numerator is either it is sales or cost of goods sold upon it is net assets. Since it is net asset turnover or capital turnover, you look into the balance sheet, you have the total of asset, and from that you remove the outside liability component. Whatever is left, that is nothing but capital employed, or you can say the net asset that we are going to have is simply the total of assets less the current liabilities, and therefore in the denominator we are going to have it as net asset. When you say net asset, that is uh, total asset minus current liability. Because whenever we are saying capital, don't interpret it in the form of that it's the capital that we had in our sole proprietor. No, what we mean by capital is the owned funds and the borrowed funds combined. Okay, so how effectively we are utilizing our capital, that is being represented by capital turnover ratio. Then we have current assets turnover ratio. It again indicates how effectively we are utilizing our current assets. So that again the numerator remains the same, sales or cost of goods sold. In the denominator, definitely we are going to have our current assets. You will include all your current assets in the denominator. Bank, debtors, stock, all of them are going to be included in the denominator. This indicates how effectively we are utilizing the current assets to generate sales. Then working capital turnover ratio. It again indicates how actively we are utilizing our working capital. That is our current asset minus current liabilities, or net working capital, net current assets also you can say. The numerator remains same, sales or COGS upon working capital or current asset minus current liability. Okay, these are some of the turnover ratios which are going to help us to understand how effectively we are utilizing our resources, how actively we are getting the resources employed for the purpose of generating sales. We have three really important ratios for further analysis, not just with respect to how effectively we are utilizing them, but also something you're going to get it connected to your subsequent chapters of working capital also. One is our inventory or stock turnover ratio. The other is receivables turnover ratio. And connected to that, again, we have the payables turnover ratio. So let's talk about the inventory turnover ratio. Let's talk about the inventory or stock turnover ratio. If I simply talk of the ratio, we want to know how effectively we are utilizing our inventory or stock. Calculation goes very simple. It is going to be COGS, cost of goods sold, upon average stock. Going to be cost of goods sold upon average stock. Sir, what if cost of goods sold information is not available? If in the question, if you don't have the COGS information, then you can simply write it as, in the absence of information, we can also take it as sales upon average stock. In the absence of information, we can take it as sales upon average stock. Now, COGS upon average stock or sales upon average stock, it indicates how effectively, how efficiently or actively utilizing your stock. But we want to go a bit ahead to understand these numbers also. Let's take an example to understand what does these numbers really signify. Suppose if I say COGS of the company is 12 lakh and average stock that it maintains Generally, sir, average stock should be computed as average of all the stocks, average of every day closing stock and divide by 365. But that's technically not possible, practically not possible for us. So what we generally do is average stock. Remember, that is going to be opening stock plus the closing stock divided by 2. This is what you would have learned even in your earlier lectures or earlier standards also. So we've got, let's say, average stock of 3. Average stock of 3 lakh. Now, if I calculate my stock turnover ratio over here, if I calculate stock turnover ratio, you'll say, it's a 12 lakh divided by 3 lakh. So what does that signify? That means it is 4. Uh, as I told you, the interpretation of the earlier turnover ratio also, here also, what does it indicate? That your COGS, the goods that you're selling, is equivalent to, and the goods that you're selling is equivalent to 4 times of your average stock. It means whatever stock you are maintaining, you're able to generate 4 times of that as your sales. You're able to generate 4 times of that as your sales. So it means all turnover ratios, remember, it's going to be always in terms of times. So if I say, let's consider a year, a full year, and this is our 12 lakh is for the entire year COGS, and average stock we have of 3 lakh. Now, if I ask you stock turnover ratio, so it is 4 times. So it means stock, our COGS or the sales that we're generating is 4 times of the stock that we maintain. Can I say it means one lot of stock that we have, which is on an average 3 lakh, one lot of stock that we have got, which is on an average 3 lakh, sir, it means we will be selling 4 times such lot in a year. So in 1 year, we will be selling 4 such lots of average stock. In 1 year, we will be selling 4 such lots in a year as the sales. Now, my next question to you would be, if I ask you, in how many months would one lot of stock, one lot of stock would be sold? If I ask you, the question is clear. 12 lakh is the COGS, average stock is 3, so stock turnover is 4 times. It means I'm able to sell 4 times of my stock as goods. It means I am selling 4 lots of such goods in a year. So if I ask you, in how many months would one lot of stock would be sold? Sir, how much time or how many months we would take to sell uh, for how many months we would take to sell one such lot? So that simply means, answer, I can see some of you are answering it correct. So in how many months? Obviously, sir, we have got 12 months in a year, and each lot can be sold in how many months? That was my question. So total 4 times you are going to sell. So sir, for each lot, we would be taking like 3 months. We would be taking 3 months, right? So for each lot to be sold, we would be taking that as 3 months. So this particular 3 months, this particular 3 months that we have stock turnover or inventory turnover, that basically indicates, also this is sometimes called as stock stock velocity, or sometimes called as stock turnover in months. It can be also expressed in terms of days, right? So this simply indicates that one lot we are going to be taking 3 months to sell one full lot. Like one full lot will be sold part by part, but for that entire one lot to be liquidated, we are going to take 3 months. Okay. So Basically, this 3 months is, we generally say this as stock holding period. Generally say this as stock holding period, or inventory holding period is also said to be on the same lines. Okay, so how do we calculate this 3 months? Pretty simple. First, get the stock turnover. 12 months divided by 4. Had it been in terms of days, we would have like taken it as 365 divided by 4. Had it been in terms of weeks, we would have taken it as 52 divided by 4. So as simple as that, the stock holding period, sometimes also called as stock velocity in days, or sometimes also called as stock turnover in days, on days or in months. So it was just COGS. So we know how to calculate COGS. COGS is our opening stock plus the purchases that we make minus the closing stock. If I ask you, sir, what should be raw material inventory? If I talk of simply raw material inventory turnover ratio, can I still have COGS in my numerator? Or with regards to raw materials, sir, do we really sell raw material? No, we don't use raw material. We're not involved in selling of our raw material. Generally, the raw material is purchased for the purpose of consumption into the activity of purchase, into the activity of production. So for this raw material turnover ratio, we are going to have the formula as raw material consumed on same, it is the average raw material stock. We can also compute the same over here in terms of months also by doing the same thing, total months divided by 4. Okay, and that is our raw material or raw material inventory or stock turnover ratio. As I told you, there is another turnover ratio which is going to be of importance to us for understanding. Receivables turnover ratio. The receivables turnover ratio, we should be in the denominator, we should be having average receivables. We generally say it as average accounts receivable. Average accounts receivables. What should be in the numerator? Sir, can we have COGS? Doesn't make sense, sir, because all my receivables will be having the values at they will be having the value at the sales value. So I cannot have COGS. So can we have sales? It's partially correct. It's not only sales. You should be specific that whenever it is receivables, please be careful. The questions may be tricky, wherein you will be given a clear-cut bifurcation of cash sales and credit sales, or at least the ratio will be given. And if such is the case, you will have to take only the credit sales. Otherwise, what we are going to see is we'll assume all the sales are only credit. But for understanding, for remembering the formula, you should take it as always credit sales. You always take it as credit sales. Now, what do we mean by, sir, average accounts receivables? What do we mean by average accounts receivables? Average accounts receivables simply mean average accounts receivable. Understand that this simply means your average debtors plus average bills receivable. So don't ignore the part that it will also include bills receivable. So if you, in case if you have in a balance sheet amount of bills receivable, do consider that part also. So how do we get the average debtors and average bills receivable? Average debtors is simply opening debtors plus closing debtors divided by 2. And average bills receivable is opening bills receivable plus closing amount of bills receivable upon. So if there is no opening, then take the closing as to be average itself. Okay, so that's our receivables turnover. It simply means for generating sales, we have to give some credit, and therefore we have the debtors in our books. So whenever we have debtors, it means how many times of our debtors we are able to sell or we are able to generate credit sales for our debtors or the receivables. Now again over here we have something to be learned in terms of days. Let's understand that part with the help of example. Suppose credit sales, there is the annual quantum of credit sales, the full year quantum of credit sales is 24 lakh. Full year quantum of credit sales is suppose 24 lakh, and we have, let's say, average debtors in our books, assuming that there is no bill receivables. So let's consider the average debtors, credit sales of 24 lakh, and average debtors we have, let's say, rupees 8 lakh. On an average, we have 8 lakh debtors in our books. So if I ask you what should be the receivables turnover, what should be the receivables turnover? So to understand what should be a receivables turnover, we can simply say, sir, it's credit sales of 24 lakh on average debtors of 8 lakh. That means it is 3 times. It simply means to generate a sales of 24 lakh, we had an average debtors of 8 lakh. So it means 3 times of our debtors we are able to generate, 3 times of debtors we are able to generate the sales. So receivables turnover we get 3 times. Now again, I asked you another question. It means, sir, I'll be selling stock to this one lot of debtors 3 times in a year. On an average, I can say I'll be selling my goods to these debtors 3 times in a year. 3 times in a year. Sir, what does that signify? What are you trying to ask us? If it is 3 times in a year, tell me, to sell our debtors or to sell one lot of debtor, how many months do we really need? So to collect, because you have these debtors in your books because you have sold it on credit. Now, when will those debtors get vanished? When you collect from them. So you sold 8 lakh, you sold 8 lakh to the 8 lakh of goods. Such 8 lakhs is going to be 3 times in a year. Such 8 lakhs is going to be 3 times in a year. It means for one lot of debtors to get vanished or to get reduced, you need 4 months. You're going to need 4 months in a year to get the entire money collected from your debtors. It means the next is debtors collection period. Debtors collection period or receivable collection period. You can say it is simply 12 months divided by 3, which is 4 months. Technically, what is happening? You sold goods today. You're going to collect after 4 months. Again, you're going to sell goods after 4 months. Again, you're going to collect after another 4 months. So in this way, you are going to have 3 such cycles. On an average, you're going to have 3 such cycles. You're going to have 3 such cycles wherein every cycle is going to be of 4 months. Every cycle is going to be of 4 months, and that is what we say this as the debtors collection period, or it's also called as receivables collection period. Right? So debtors collection period, or also called as receivables collection period. Okay, fine. So that was about receivables turnover. Now, if you ask me, sir, which company is better? Which is having a stock turnover or maybe receivables turnover higher or lower? Which company is better? If suppose in our case it was 4 times, if there is another company wherein the stock turnover, is, let's say, 8 times, which company is better? If this is company A and there is another company which is having a stock turnover of, let's say, 8 times, so which company is doing business in a more active or in a more efficient manner? My answer is going to be obviously 8 times. Obviously, the company which is generating sales, which is 8 times of its average, 8 times of its average stock, because you are utilizing the same stock more and more number of times, so that is giving you additional profits. Raw material inventory turnover ratio also on the same time, it means indicates that how effectively you are utilizing. So higher the inventory or stock turnover ratio, better it is, because it indicates you are utilizing your assets in a more effective manner. Utilizing the assets in a more effective manner. So it is 4 times better. Obviously, 4 times is less turnover. 8 times is an even better thing. And you can also understand that if it is 8 times, so the time required to sell one lot of stock will be also lower. It won't be 3 months. It will be half of it, which is 1.5 months. So it means that I need not hold my inventory for long. It gets sold very easily in a short span. Right? So 8 times is obviously the correct answer. Now, same goes with even receivables turnover. Sir, a company is having a receivable turnover of 8 times. There's another company which is having a receivable turnover of, let's say, 10 times. If it is receivable turnover 10 times, this is our company A with 3 times. There is another company B which is having a turnover of 10 times. Having a turnover of 10 times. Of course, company B is better. It will also tell you that, sir, it is 12 by 10, which is 1.2 months. 1.2 months. It means, sir, this company is taking 4 months to collect money from the debtors. This company is taking just 1.2 months. So this company is having a more level of activity because it's getting the money very easily and it's getting the money at a faster pace in a quick manner. So of course, receivables turnover wise, uh, lesser the duration, better it is. Higher the turnover, better it is. Now payables turnover, as you say, the formula is pretty simple. Payables turnover is, we are interested in how effectively we are utilizing the creditors. So payables turnover is simply going to be average net credit purchases upon average accounts payable. Now accounts payable, you realize that includes both creditors as well as your bills payable. It includes both creditors as well as bills payable. Now again, payables turnover, it is going to be in so many times. If I want in days or months or in weeks, which is also said to be like uh, creditors payment period. Creditors payment period, we can simply do it as 12 by 12 or 52 or 365 by payables turnover. Just as we had over here, debtors collection as 12 divided by 3, which is 12 months divided by the receivables turnover. Payables turnover is also going to be on the same length. If it is months, it's 12 divided by payables turnover. If it's weeks, 52 divided by payables turnover. If it is days, it can be 365. Sometimes you can also have it in the form of 360 also, if the question specifies. Okay, so these are our turnover ratios that was pending. After that, we have definitely discussed certain return ratios. We have few very simple ratios that we need to discuss. First of all, gross profit ratio. We are very much aware that gross profit ratio is simply gross profit upon your sales figure in 200. So that is always specified in terms of percentage. The net profit is always going to be your profit after tax on sales in 200. Operating profit ratio, whenever it is operating profit, remember It is your EBIT, earnings before interest and tax, on sales into 100. Okay, so operating profit is simply going to be EBIT. Sir, what is this EBIT? Can you give some other term? Yes, you can say EBIT is nothing but sales less COGS less operating expenses. Sir, what is included in operating expenses? What all things are included in our operating expenses? In the operating expenses, you have admin expense, you have selling and distribution expense, right? So operating, it includes two things. One is your admin expense and other is selling and distribution expense. Now, expense ratio. Some of the simple expense ratio. One is our COGS ratio. Then you have operating expense ratio. Then you have operating ratio. Then the other is simply finance expense ratio. COGS ratio, it's simply called as cost of goods sold ratio. That is simply COGS upon sales into 100. So it simply says what proportion of sales is COGS. Operating expense ratio. Operating expense ratio. It is simply going to be your operating expenses. Operating expenses upon sales into 100. Operating ratio. Operating ratio is COGS plus your operating expense upon sales 200. Operating ratio is COGS plus operating expense upon sales. Now, operating expenses, as I told you, it includes this one. So, operating ratio considers COGS and operating expenses, which is admin and selling together. And finance expense ratio is just one and the same, which is finance expense upon sales into 100. Okay, so that is simply going to be the finance ratio. So all your finance expenses will include like interest or bank charges, all those things are going to be included. So this finance expense is not going to include any sort of taxes or anything like that. Okay. We have discussed what are the return ratios in the previous class to understand what was capital gearing. We have discussed the market ratios also. We have discussed the PE, dividend yield, earnings yield also in the previous class. We have two simple ratios and the DuPont analysis. So let's simply look into this aspects now. One is the market value to book value ratio, and other is the Q ratio. Market value to book value is one such ratio, and other is the Q ratio. Now, what is market value to book value? As the name says, it is market price or market value per share in the numerator. So market value, we generally take it as a market price per share upon. Sir, how do you get this book value of a share? Book value of a share simply means, book value of a share simply means whatever is your net worth, whatever is your net worth, or you can say whatever is your equity shareholders funds divided by number of equity shares. So equity shareholders funds is the value, is the book value of all the funds that the company is employing. You divide it by number of equity shares, so you will get the value of each share in the books. So in the market, it is different. Yes, it will be different. In the market, price will be different. In the books, it's going to be different. Both of them cannot be equal. In the market, it is determined by the demand and supply factor. In the books, it's based on the past reserves, profits, or equity shares capital raised. So equity shareholders fund, we have already discussed that in the previous class also. Equity shareholders funds include equity share capital plus reserves less fictitious assets. Okay, so this divided by number of equity shares, equity shareholders funds divided by the number of equity shares is going to give me the book value. So definitely the ratio is going to be market price per share divided by book value per share. So how do we get the book value? We get the book value like this. We get a typical book value on this number. So book value per share, it will be simply total of share capital reserves less fictitious assets divided by number of equity shares is going to be your book value per share. So this ratio is helpful in understanding how the market is perceiving the typical company with regards to its book value. So sometimes this ratio is widely used in undertaking something called as value investing. Again, as I told you in the previous lecture also, there's a concept in investment industry where we say it as a value investing. It means the investors, the smart investors, are always in search of such companies which are having a low value right now, low value in the market right now, but they have a huge potential to grow. And this ratio helps us to understand, identify such companies. Basically, if you say there is a similar company, there's company X, there's company Y, there's company Z. Company X is having a market to book value ratio of, let's say, 2 times. It means the market value is twice of book value. Company Y is having this ratio to be, let's say, 4 times, and company Z is having this to be like 3 times. Same industry, same performance, right? Same industry, same performance, we say. So, but this company is having a lesser market value. It means this company is having a good potential for rise for the capital appreciation in the value of the company. Right? So this can be a big, it can be a bet for you for investment. But again, you need to analyze further as to how much the company is generating profits. What are the cash flows of a company? So you need to undertake some further analysis for this also. Okay, so market value to book value ratio stands like this: market price per share to book value. Then there is a Q ratio, very simple ratio, wherein we consider the Q ratio as simply market price per share, or instead not per share basis, we take it as market value of company as a whole. That is all the shares of a company taken together. What is the value of the company? That's the market value of a company. Market value of company on, instead of taking the book value, we simply say what is the assets replacement cost. Say replacement cost of assets. This ratio, again, it's a another version of market value to book value. Instead of taking book value, we say what is the value of the company assets? What's the value of the company assets and the replacement terms? Okay. So again, this ratio indicates higher ratio. It indicates the market is having assigning greater value to a company as compared to its assets. So this also helps us to identify the companies which will be undervalued and has a huge potential for growth. Okay. Sir, what is debtors turnover? Debtors turnover, payable turnover are same for one company? Yes, they are same for one company. Then difference in book value and market value. Book value is, as I told you, book value is equity shareholders funds upon number of equity shares. This is based on your balance sheet figure. Based on your balance sheet, you take a total of equity share capital reserves and reduce it by fictitious asset. That will give you book value. Whereas market price is the market price of the share on the stock exchange. Okay, we're done with all the ratios. We're left with one thing, that is understanding of DuPont analysis or DuPont chart. Basically, it's not a chart, but understanding how the companies are generating returns. That's what we say it as a DuPont. Now, let's understand what is this DuPont. Generally, we say return on equity. Return on equity, that is the return that we are generating for the equity shareholders. We simply take it as return on equity as profit after tax upon equity shareholders funds. Take it as return on equity as what? Profit after tax upon equity shareholders funds. DuPont analysis helps us to connect or helps us to understand uh, from three areas we are actually generating the return. We are getting the return for our equity shareholders from three different areas or three sources. Right? Can we say replacement value as acquiring value? Current acquiring value, you can say. What is net worth? Net worth is equity shareholders funds, is equity share capital plus reserves less fictitious assets. Okay. So DuPont helps us to understand how we are going to generate this return on equity. So DuPont analysis simply says the return that you are generating for your equity shareholders, it is affected by three factors. That is affected by three factors. Those three factors are, one is profitability. It means what is your profit margin? What is your profit margin? What is the net profit to your sales ratio? I mean, how, if you're selling 100 rupee, how much of that is your profit that you're generating? That is your profitability. Second is how many times you are able to sell the goods to your customers, to your debtors. So that indicates your turnover or how effectively you are utilizing your resources. Third is equity multiplier, which is about, I can say, capital gearing. Is about capital gearing, or what we say also as leverage. That is debt equity ratio. So talking about DuPont analysis, the return that we generate, return on equity, that is profit after tax upon equity shareholders funds. As I told you, it's going to be three. It's a function of three parameters. One is profitability, how much profit you are generating on each sale that you're making, how much turnover, and how much equity multiplier. That profitability is indicated as PAT upon sales. So this is our net profit ratio. Yes, definitely you're correct. This is our net profit ratio. The turnover, we say that it is sales upon you can say capital, or you can say assets. So let me just take it as simply assets. So equity multiplier, I'm saying it to be assets upon equity shareholders funds. So this indicates what percentage of sales is profit. This indicates how many times, this indicates how many times assets, or how many times of assets is sales. Equity multiplier indicates assets to owned funds ratio. It means if you have a higher asset as compared to equity shareholder, so if I have more assets than equity shareholders fund, how did I finance those assets? Definitely I would have taken a loan, or I would have maybe issued preference shares. So that's the equity multiplier. So if I want higher return on equity, if I want a higher return on equity, that means either of these should be higher. It means if there is one company which is having a lesser profitability, if there is a company which is having a lesser profitability, that is a margin that they sell is roughly like 5%, 2%, or 3%. But still, that company can generate higher return on equity with the help of these two parameters. If a company, profitability point of view, if a company is able to generate just 5% return, whereas if it is able to help generate turnover in a better sense, so these two factors are going to play an important role in generating the higher return on equity. So if any of these three is a weaker point of your company, you can target the other one. So if you're in an industry, if you're typically in an industry wherein the turnover is low, it means you have to employ heavy assets. You need to have a very huge amount of assets, and those assets will be used for the purpose of generating sales. But I can attain higher return on equity if I am able to have a higher profitability. Let's say, for example, just for an example, uh, let's say a clothes showroom. A cloth showroom, they have variety of garments, right? Variety of wide different colors, types. They need to have a huge inventory. They need to have a huge inventory, and that's where they maintain a high asset base. So, sir, if there is huge inventory, if there is huge amount of asset, the turnover number is definitely going to be lower. It's not going to be that. In fact, it's the case that you have to keep the entire year's stock or full annual stock with you. So your turnover is somewhere, one time or maybe even lower than that. But those businesses are able to survive or able to generate good return for their equity shareholders by having higher profitability. By having a higher degree of profitability, they can have, or I can say their margins. Their margins are like GP margins and NP margins are a bit higher numbers. Okay, so high turnover. If there's a company, sir, where if we have a company wherein the profitability is low, like they just have a margin of 2 or 5%, no issues in that. In that case, you should be able to generate a higher quantum of turnover. Basically, if you observe, sir, if I multiply all three of them, you will find that it's just the same return on equity. Multiply this thing, all of them, you will observe that sales get cancelled, assets get cancelled, and what you have is PAT upon equity shareholders funds. Okay. So DuPont analysis helps us to understand, break up the performance of a company. It also helps us to analyze why the company is not able to survive, or why the company is not able to generate good amount of returns for its shareholders. You can actually go deep down and see where is the problem line. Is the problem with the profitability? Is there a problem with the turnover? Is there a problem with the equity multiplier, or what is the issue? That helps us to further analysis the three layers or three different factors that affect the return on equity of the company. That is about the entire conceptual part for ratio. Now let's quickly begin the questions. So let's look for now module questions. We'll be discussing the module questions. Wherever I feel that I should solve it, I'll definitely solve that question. Otherwise, we're going to look into all the questions. Maybe one or two I may just give you as homework just for practice. Otherwise, I can say, we can definitely go ahead with discussing all the questions. So let's get started with the if you have any queries, why assets in equity multiplier. Basically, if I would like to answer you in a simple way, so that I can cancel out these two asset numbers and get ultimately the multiplication of it. But the logic is, we take this assets upon equity shareholders. We want to see how many times of our equity shareholders fund is our assets. That is, how many times of our owned funds is the value of assets. Okay, how many times of our equity shareholders funds is the assets. So if you have an asset higher than equity shareholders funds, that indicates you would have borrowed from outside. And just in the last class, in the yesterday's lecture, we saw, not yesterday, I think few days back. I don't know. It was on Thursday, I suppose, Thursday or Saturday. So we saw that a company with a gearing, or I can say with a debt, it will be able to generate higher returns if it has got these two. I can say return on capital employed as a better, if it is that is higher, if that is beyond the rate of interest, you will be able to generate higher returns. Okay. What is the practical use? Practical use, as I told you, for the analysis purpose. What is the strong point of a company? What is the weak point of a company? So suppose if I ask you, there is company A, there is company B, it has got 20% return on equity, other has also got 20% return on equity. If I just want to go into depth and understand what is the strength of company A, is it good with regards to profitability? Is it good regards to margins? Is it good with regards to turnover, or is it good with regards to equity multipliers? So I can just analyze both the companies and just look into some of the risks and advise my company, advise my client as to what is the risk they are facing. If a company is operating on low margins, low profitability, I should ask them to concentrate on turnover, because the moment that turnover drops, their profit is also going to be going down. Okay, for this, we have to divide FY into asset turnover types. I will get that question. There is the cost of goods sold and cost of sales the same. No, dear, it's not the same, because cost of goods sold, in the cost of goods sold and cost of sales, there's a difference. The difference lies with the selling and distribution expenses. So when you include selling and distribution expenses, that becomes your cost of sales, and also including your admin expenses. Can we say equity multiplier is 1 upon equity ratio? Yes, you can say 1 upon equity ratio, because that's asset upon equity shareholders. If you reverse it, you can say it is a equity ratio. Okay. Next, let's say let's get started with the module questions without any more waiting now. Let's get started with the questions very quickly. First question. In a meeting held at Solent towards the end of 2019, directors of Messrs. HPCL Limited have taken a decision to diversify. At present, HPCL sells all finished goods from its own warehouse. The company issued debentures on 1/1/2020 and purchased fixed asset on the same day. The purchase prices have remained stable during the concern period, and the following information is provided. So we have information for 2019 and 2020. They've got cash sales, they've got credit sales, we took a total of it, reduced the cost of goods sold, and we got a GP. Operating expenses include your warehousing, transport, administrative, and selling expenses. And then your net profit is 15,000 or 19,000. They've been given the balance sheet of 2019 and 2020 also. Fixed assets, which is net block, that is after providing for depreciation. Receivables, cash at bank, stock. Total current assets stands as this, as reduced by the payables. So your working capital stands like this, which is represented by fair capital, reserves and surplus, and debentures. It's a concise form of balance sheet and the income statement given to us. We are required to calculate the following ratios for the year 2019 and 2020. Please explain the replacement cost of asset. Replacement cost of asset simply means you look into the company balance sheet. In that company balance sheet, look for the assets. So whatever assets the company is putting up in the balance sheet, whatever the assets the company is putting up in the balance sheet, those are book values. They will be recorded cost, depreciated, right? The inventory will be valued at cost or NRV, whichever is lower. There is another concept of writing down the values, that is for each of the assets. For example, if the company is having a building, so building valued at some 50 lakh, let's say. So when we say replacement cost, we say if I want to construct a similar building today, what will be the cost of that? That is our replacement cost. Land in the books will be recorded at the cost which we would have purchased. So there we would be saying like, if I want to purchase a similar land today, what is the cost? That's the replacement cost. The inventory is recorded cost or NRV, whichever is lower. It means cost was a past price, NRV is the current price less the ready selling expenses. So if I want to get those inventory today, what is the cost? That is our replacement cost. So you can say current value or the value of getting that asset today in again in a new form. That's what we say it as a replacement cost. I hope replacement cost is answered. Let's quickly go for this question without any more waiting. We have to compute gross profit ratio, operating expense to sales ratio. We have to get the operating profit, capital turnover, stock turnover, net profit to net worth, receivables collection period. So ratio relating to capital employed should be based on capital at the end of the year. The question is clearly stating that portion. Then it is simply saying that ratio relating to capital employed should be based on capital at the end of the year. Then we have given the reasons for change in the ratios for 2 years. Assume opening stock of 40,000 for the year 2020 and ignore the taxation portion. So from this figures that we have got, we have to compute certain ratios. So I presume that you guys are holding the model with you, but in case it's not visible or something like that, we can. First, the question is asking us what is GP ratio. So I'll be solving it in a short and fast manner. Okay, so that we can save on time and also be able to complete the questions. So first up, GP ratio for both the years 2019 and 20. So for 2019 and 2020. Let's say GP ratio, gross profit ratio. So for gross profit, what we need is a GP upon sales. So GP upon sales is this 64,000 and 76,000 divided by sales of 3 lakh and 374. So that is simply 64,000 divided by 3 lakh into 100 because we want to express in terms of percentage. For 2020, it is 76,000 divided by 3,74,000 into 100. Okay, so if you calculate it, you can simply get the answer as 64,000 divided by 3 lakh into 100. That is 21.33%. Whereas for 2020, it will be 76,000 divided by 3,74,000 into 100, which is 20.32%. It's just the initial question. I just calculated it. Rest all numbers, I'll be just putting the numbers. Calculations, I presume that you guys can do because you can do it simply on calculator. Post GP ratio, we have operating expenses to sales ratio. So operating expense to sales. Operating expense to sales ratio. So operating expense, we already have the operating expense figure over here, 49,000 and 57,000. I can say it is 49,000 and 57,000 divided by the sales value. Sales value is again same 3 lakh and 3,74,000. No doubt, multiply it by 100 to get in terms of percentage. You can calculate that. Next ratio is operating profit. Operating profit ratio, which we know operating profit is also available to us. Like all this GP was there. From GP, we subtracted all our operating expenses. So even these net profits are nothing but our operating profit only. So operating profit will be 15,000 divided by 3 lakh into 100. And for 2020, it's going to be 19,000 divided by 3,74,200. Then after operating profit ratio, next is capital turnover ratio. Capital turnover ratio. Capital turnover is simply sales upon the capital. Sales upon the capital that is fully employed. So we have a sales figure of 3 lakh and 3,74,000. And as I told you, all our turnover ratios are always going to be in number of times. 3 lakh divided by the capital that is employed. Capital employed is 1 lakh and 1,47,000. That's 1 lakh and 1,47,000. So you can get the answer as simply so many times. Okay. After capital turnover, next is stock turnover ratio. So stock turnover ratio, you can simply compute it as stock turnover when it is, we take COGS, right? So COGS upon average stock. So COGS for the first year, we find that it's 2,36,000. COGS is 2,36,000. And over here, the COGS is 2,98,000. COGS 2,36,000 and 2,98,000. Divided by, we need the average stock figure. We need the average stock figure. Average stock, we have to take it as opening and closing. So for the purpose of average stock, let us first compute over here average stock. For 2019, average stock, for that we have like opening stock of 2020 to be 40,000. Opening stock of 2020, so there's a this typical thing because whatever we have stock of 60,000, the stock of 60,000 was 2019. So there's a mistake in this module. So instead of opening stock for the year 2020, it should be 2019. For the opening stock of 2019, we have a stock of 60,000 as a closing stock of 2019, and opening stock was 40,000. I can get an average stock as 40,000 plus 60,000 opening plus closing divided by 2, and the other side it will be for the next it is opening and closing, which will be 60 plus 94 divided by 2. 60,000 plus 94,000 divided by 2. So this comes out to be average as 50,000, and the second one will give you an average of, you can say, 60,000 plus 94,000 divided by 2. That will be 77,000. You can divide this by 50,000 and 77,000, and you'll get the answers in so many times. Stock turnover is done. Then we have net profit to net worth. 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 Now net profit is simply indicated over here 15,000 and 19,000. You can write this as 15,000, 19,000 divided by net worth. Net worth is only the owner's fund. So owner's fund is like this case, total of this is 1 lakh, The other side, it is like total of these two will be like 1,17,000. This divided by 1 lakh and 1,17,000. This particular ratio, net profit to net worth, typically they are talking of return on equity sort of thing. So both of them are going to be in percentages. Final ratio, which they are asking us, is like receivables collection period or debtors collection period. So debtors collection period, I'm going to tell you how do we compute it in a bit different way. So first, let's compute for 2019 and for 2020. What is our debtors turnover or receivables turnover? Receivables turnover is going to be simply the credit sales component only. The receivables turnover is 2,70,000, and in the other case 3,42,000 divided by, we need to divide this by receivables turnover. So we'll need average debtors. So there is no information regarding opening debtors. So let us take this same 50,000 as our debtors. So it is 50,000, and here it is 82,000. So you can get this answers as 2,70,000 divided by 50,000 as one of this is 5.4 times. The other, it is 3,42,000 divided by 82,000 is 4.17 times. So many times we sell to our customers, to our debtors in a year. So if I want to say collection, receivable collection period, suppose I want to calculate it in number of days. So I take it as 365 divided by 5 points. And this is 365 divided by 4.17. If you get that, 365 divided by 5.4 is somewhere like 67.59 days. On an average, you take roughly around 68 days to collect your money. In the second case, it is 365 divided by 4.17. That is 87.53 days. So the debtors collection period has increased, mean you're taking too long to collect your money from our debtors. Okay. Can we take average debtors of 2020? Yeah, we can, but then just to maintain the uniformity, since we are taking closing debtors, so let's maintain that uniformity. Therefore, we are looking at this. Okay, so with that, we have completed question number one. Completed question number one. I hope it was good with you. We'll look for the next set of questions. First, let's take a break right now of 5 minutes. And after that, we will continue with the subsequent questions. Let's take a break of 5 minutes, guys, and we'll get started in this next 5 minutes. Welcome back after the break, guys. Let's continue now. Some queries we have: can we round off the collection period? Better not to round off because these are anyways the average period. These are not exacting. So on an average, you take 67.59 days, not to round it off. In 2020, we can take an average of receivables, that is 50,000 and 80,000. Yes, we can take, but then the consistency will be hampered. For 2019, you're taking the closing figure, and for 2020, if you take the average of it, then there won't be the consistency. So consistency is going to be affected a bit. So therefore, I prefer you to not take the average. So let's quickly go for some more questions. Some really, really good questions. Question number 2 is an elaborate one. It has got a lot of things because we have to prepare something like the next year's trading P&L, and we have the next year's P&L as well as a balance sheet to be prepared. So let's get started with the question, guys. Following is the abridged balance sheet of Alpha Limited, which has a share capital of 1 lakh, profit and loss of 17,000, current liabilities of 40,000, land and building of 80,000, plant and machinery 50, depreciation, stock, receivable, bank, blah blah blah. With the help of additional information furnished below, you are required to prepare trading and profit and loss account and the balance sheet as on 31st March 2020. Okay, bridged balance sheet is given. Want us to prepare the P&L. So please, sir, this is what are they really saying, sir? It is like balance sheet is already given. Why are they asking us to prepare a balance sheet? Now that is a quite common sense that this may be our balance sheet in the beginning. Let's see what all things we can get from the question. The company went in for a reorganization of capital structure with the share capital remaining the same as follows. So share capital remains the same, but they have share capital as 50%, other shareholders funds 15%, debentures 10%, and payables 25%. So these are like the total liabilities that they have got. Debentures were issued on 1st April, interest being paid annually on 31st of March. Land and building remained unchanged. Additional plant and machinery has been bought, and a further 5,000 depreciation is written off. Okay, there's a good adjustment with regards to land and building. Working capital ratio was 8:5. Quick assets ratio was 1:1. Receivables, 4/5 of the quick assets to sales ratio revealed a credit period of 4 months with no cash sales being undertaken. So we have to assume all our sales is credit sales only. Return on net worth is 10%, GP of 15%, stock turnover was 8 times. We have to ignore the taxation and we have to solve this typical thing. Now, let's get started with it. I may use short forms in my solution. The formal solution, you will definitely find it in the module. But my whole idea of solving this question is that you get an idea how to proceed with the calculation. Okay, so in exams, please don't use the shortcuts as I'm using, because my whole idea is just to let you know how do we understand the flow of the question. First of all, we have the opening balance sheet, and they say that the company went in for reorganization with this sort of capital structure. And they say that the share capital is remaining same. So accordingly, I can say that my share capital, uh, other shareholders funds, I'm just using the short forms just to get into it so that we can complete the question quickly. Then we have got 5% debentures and payables. Basically, this is a liability side of our required balance sheet. This is the liability side. They're given us the percentages to be 50%, 15%, 10%, 25%. One thing is given to us that your share capital remaining the same. What was our share capital earlier? It was 1 lakh. So share capital over here, it will be also 1 lakh. It's not going to change. So if share capital is 1 lakh, which is like 50%, so we can get these numbers also quickly. You can say, sir, 1 lakh is for 50. How much for 15? Should it be 30,000? Should it be 30,000? Then for 10%, accordingly, you can get the answers as 20,000. For 25%, it should be like, this 25%, it should be 50,000. So total of our liabilities, we get 2 lakh. This liability is our total liabilities, total of all liabilities, right? So basically, if I just prepare a balance sheet in my mind, we have got the liabilities comprising of these 4 items. Now let's go into the other things. Debentures were issued. So when I'm preparing my P&L, I have to consider debenture interest accordingly. Land and building remain unchanged. Additional plant and machinery has been bought for a further 5,000. Depreciation has been written off. That they say total fixed asset then constituted 60% of total fixed assets and current assets. Okay. So we have total liabilities as 2 lakh. So our total liability should be equal to total assets of 2 lakh. So total assets means it should be fixed asset plus current assets. Fixed asset plus current assets should be 2 lakh. Now they further say that our total fixed asset is 60% of total fixed asset and current assets. The fixed asset is 60% of the total assets. So it is 60% of 2 lakh. 60% of 2 lakh, it means fixed asset is 1,20,000. As on the closing date, we have the fixed assets to be total to be 1,20,000. Now I have to adjust land and building and plant and machinery value from that. Get what land and building or what additional machinery we have purchased. Now we can definitely say that out of this 1,20,000, our land and building remain unchanged. They're saying land and building remain unchanged, so it means land and building continues to be at the earlier figure of 80,000. Okay, looks like. So then what about the rest 40? Rest 40 will be definitely plant and machinery. Plant and machinery. The rest 40%, 40,000 will be plant and machinery. But this plant and machinery will be opening, closing. Obviously, it will be after providing all the adjustment, because there's all information of closing figures. So this plant and machinery 40,000 is our closing value of our plant and machinery. Our closing value of our plant and machinery. So how will I know what is the plant and machinery that we purchased and what is the depreciation that we have written off? Let's prepare our simple accounting thing. Let's prepare a ledger. We have a closing plant and machinery of 40,000. Opening plant and machinery, we had, can say the opening plant and machinery, net opening plant and machinery, we say it is 35,000. Okay, we said 35,000 is the opening plant and machinery. So then the question says you have to provide for additional depreciation. So the current year we would have provided a depreciation of 5,000 also. Is it tallying? Is it tallying? On the other side we have 45,000, on this side we have 35,000. So there is a difference. They've got a difference of 10,000. What is this difference? This difference is nothing but purchases. Purchase of plant and machinery. Is a new plant and machinery that we have purchased or addition to our plant and machinery. Okay, great. So this is one thing. Then we've got almost all the information from here. Using the other one, working capital ratio is stated to be 8:5. Working capital ratio 8:5. So, sir, we'll have to look into now the working capital area. Working capital area, for that, let us say working capital thing. We definitely know how much is our fixed asset. Fixed asset plus current asset, we know it is 2 lakh. Out of which fixed asset we already know 1,20,000. 1 lakh 20 plus current asset is 2 lakh. So the current asset will be 2 lakh minus 1 lakh 20, which is 80,000. Got the current asset to be 80,000. Now we have got a working capital ratio of 8 is to 5. The working capital ratio of 8 is to 5. It means I can get my current asset to current liability. Just verify the current asset is there. Current liability, we have payables of 50,000 automatically. So, sir, what is the use of that working capital? It has got no use now because it is matching. Current asset 80, current liability payables 50. So 8 is to 5 ratio is perfectly matching. You need not worry about what is that ratio, how it is to be used, because anyways the ratio is properly matching. 8 is to 5. Then secondly, let's if we talk of the thing, current asset we got it as 80,000. The next ratio that we can use for our further uses, quick assets ratio. The quick ratio is given. Quick ratio is given as 1 is to 1. So how do we compute this quick ratio? We compute this quick ratio as current asset minus stock minus prepaid expense. Now here I'm making an assumption that there is no prepaid expense, which is a very safe assumption. It's a very safe assumption that we need not say that company can survive without prepaid expenses, but it can't survive without stock. So no prepaid expenses. So it is current asset upon stock minus current liability. So 1 upon 1 is current asset of 80,000 less stock. Don't know what is stock, sir. Current liability, we know, sir, it is 50,000. So we just form this equation and that becomes like 50,000 is equal to 80,000 minus stock. Basically, stock is equal to 80,000 minus 50,000. So stock we will have it as 30,000. Stock or inventory we have 30,000. Let's use another ratio. Next ratio is quick ratio is receivables. So they say receivables, which is 4/5 of quick assets to sales ratio revealed a credits period of 2 months. There was no cash. So receivables ratio, receivables to sales, receivables they're saying it is 4/5 of quick assets. So it's 4/5 of quick assets. So what is our quick asset? Quick asset is simply current asset of 80,000 minus stock of 30,000. Quick asset is 50,000. So what will be our debtors or receivables? So debtors or receivables will be 4/5 of this is simply 40,000. Debtors or receivables is simply 40,000. We get this receivables answer as 40,000. Another number that the question has given us is that receivables to sales ratio revealed a credit period of 2 months and there was no cash sales. We have a credit period of 2 months. They have been given a credit period of 2 months. So debtors collection period is 2 months. Sir, how do we get this 2 months? We would have got this 2 months as 12 divided by debtors turnover. That is equal to 12 divided by debtors turnover is equal to 2. It means that debtors turnover would be 6 times. So, sir, how do we get this debtors turnover? Debtors turnover is your credit sales. Is our credit sales upon debtors turnover is our credit sales upon the average debtors. Now, there is no information about average debtors. So, we'll simply take this to be our average debtors itself. So 6 is equal to credit sales on average debtors of 40,000. We get credit sales figure to be 2,40,000. We have got a credit sales, or even this itself is our total sales because there's no other sales specified. Next ratio, we say return on net worth was 10%. So return on net worth, for that we have time because we have to compute the net worth first. But I can use this GP ratio. GP ratio is 15% of selling price. So we can get our GP, which is 2,40,000 into 15%. So GP is 2,40,000 into 15%. Ideally, it should be 36,000. Got the GP. Then coming to the next part, which is about the net worth. Now, net worth, we know it is all owned funds. So owned funds is like this, these two, 1,30,000. So net worth is 1 lakh plus 30,000, which is 1,30,000. And we have the number as return on net worth is 10%. So return on net worth is 10%. That is, I can say 1,30,000 multiplied by 10%, which is 13,000. And this 13,000 is nothing our profit after tax. Is our profit after tax or net profit, you can say. Right. So I think we have used all the ratios. One thing is the stock turnover was 8 times for a year. So stock turnover is something which is, I think we haven't used it, right? Stock turnover. Stock turnover will be helpful for us to get the value or the value of stock, because I need to have the amount. In fact, we have got the stock also as 30,000. Yes, got the stock also as 30,000. So I have to use this stock turnover was 8 times. I use that stock turnover as 8 times. What am I really going to get? What am I really going to get? Because we have already have the GP. If you use the stock turnover eight times, sorry, 30,000. If you multiply it by 8, because stock turnover is simply COGS or sales by stock, that is 8. So ideally, sir, this is 30,000. 30,000 into 8, sales should be 2,40,000 or COGS should be 2,40,000. That is already availed by us. Already computed the credit sales. So stock turnover is not going to be of any use to us. If I ask you the P&L statement, how is it going to look like? First, we will have the sales figure, which we computed as 2,40,000. Sales was computed by us to be 2,40,000. On that, we have the information of GP. GP is 36,000. So GP of 36,000. The balancing figure will be our COGS. COGS is like 2,04,000. Right? And then from GP, we have to compute the other expenses and then get the net profit. So net profit is calculated by us PAT of 13,000. Net profit is 13,000. What is the balance left over? Never forget, we have the debenture interest also. So debenture interest, we had like the amount of debenture which we had in our books. Debenture was 20,000 at the rate of 5% was the rate of interest. 10% it was, but 10% was a component of it, but the rate of interest is 5%. So 5% of 20,000. So it is 5% of 20,000 will be 1,000 rupee. So GP less debenture, still there is some balance left over, sir. So whatever is the balancing figure, you can say they are all your other operating expenses. What can you say about the balancing figure? It will be all your operating and admin, selling, and all such expenses. It's 22,000. That is our PN. Talking about the balance sheet now. Balance sheet. We have got the land and building. We have got plant and machinery. We have like stock. We've got debtors and debtors, stock, debtors. On the other side, we have share capital. We have P&L balance. Reserves, we can simply say. We've got the debentures. We have got the creditors or the payables also. So out of this share capital, we have already computed these numbers. The numbers like 1,30,000, 20, and 15. So share capital is 1 lakh. Other shareholders' funds is simply reserves, which was 30,000. Debentures, we had seen it is 20,000. Creditors, we have already computed at that to be 50,000. Land and building value, we are having it as 80. Plant and machinery, we have valued it to be like 40,000. So land and building, 80. Plant and machinery is 40,000. Amount of stock, we have already calculated the amount of stock to be 30,000. Stock is 30. Debtors, also we know it is 40,000. Got all these numbers, and the only thing now to observe is it's not getting tallied. What will be the value of, I can say, the amount they won't be getting tallied? Why debenture interest is shown separately? Because the question has given information about what is the rate of interest. Depreciation in plant and machinery. This 40,000 depreciation that are written, that is after taking into account the depreciation portion. Closing plant and machinery was 40,000. Closing plant and machinery was 40,000 after taking into account the depreciation. So now if you see, it won't be getting tallied because it's like 80, 80, and this 80, 80, 160, and 30, 190. Whereas in this side it is 20. So whatever is the balancing figure, that is what we can say safely as 10,000. You can portray this plant and machinery also like this, like we had, suppose the opening plant and machinery is 50,000, plus you purchase additional 10,000, then you reduce your earlier depreciation of 15,000 and this current year depreciation of 5,000 also. You can show it like this. So when you prepare a formal proper balance sheet, you can follow this. GP is calculated on credit sales. I use GP is not on credit sales, it's on total sales. Question is saying that there is no cash sales. You observe over here, the question says uh, there were no cash sales. So all your credit sales were the total sales itself. With that, we are done with question number 2. Let us quickly go ahead with the next one now. Illustration number 3. Illustration number 3. I won't be solving this on the whiteboard. I'll be simply going through the solution. Why did you take 60% in CA, 60% in current asset? Where did I take 60%? I don't know what you're saying. 60% in CA, where is it? What are you talking about? You can consider current asset of 80,000 and balancing figure will be bank balance reducing stock and debtors. Yeah, you can say that. Current asset also you can say, yeah. Anyways, it's total 80,000. So 10,000 should be cash in bank case. Will we not record depreciation, profit and loss? You can record that. That will be included in your operating expense portion. You can record that definitely. Let's go for illustration 3 now quickly. X company has made plans for the next year. It is estimated that the company will employ total assets of 8 lakh. 50% of the assets being financed by borrowed capital at an interest cost of 8% per year. The direct costs for the year are estimated at 4,80,000 and all other operating expenses are estimated at 80,000. Goods will be sold to customers at 150% of direct costs. Tax rate is assumed to be 50%. They require to compute the net profit margin, return on assets, and asset turnover, return on owner's equity. Let me go through the swipe through this solution itself. First up, to start with sales, we have the asset base of 8 lakh. While we're preparing T form of balance sheet, you can prepare the vertical form also if you have so much time in exams. Net profit of 13,000 is not considered in balance sheet. Who said that? Total, when I'm saying reserves of 30,000, already 13,000 is included in it. Okay. X company has made up plans for next year. It is estimated the company will have all these things, and they're asking us to calculate few ratios. Now, I need to have first the net profit figure, or even the operating expenses and all those figures. So an income statement needs to be prepared, for which we'll be using this. Goods will sold to customers at 150% of direct cost. And the question says that direct cost for the year are estimated to be 4,80,000. So we can say direct cost agar 4,80,000. Sales should be 150% of this. It says 7,20,000, right? So we have a GP of 2,40,000. Operating expenses of 80,000, which is given to us. Finance expense or interest charges. Interest charges will be simply borrowed capital, in which we say 8% per year. Now, 8% of what, sir? So 8% of what? We'll say company has a total asset of 8 lakh, out of which 50% is being financed between and borrowed capital. So half of your assets are acquired by borrowed capital. Half is means 4 lakh. 4 lakh into 8% is your interest charge. Interest charges. So that is this. And then profit before taxes is this. Tax figure, they say it is 50%. So we get this number. Now talking about the ratios. Net profit margin. Net profit margin. Net profit margin. So it is net profit upon sales. Net profit upon sales. The number. You can also say net profit margin as EBIT upon, but I'm personally not in favor of this number, because whenever it's a net profit, it's always going to be this 8.9%. You can say that post-tax operating profit is this. Instead of net profit, you can say this is our post-tax operating profit. Then next is return on assets. So return on assets, for that we need the return that we have generated on assets. So return on assets is same as maybe your return on capital employed. So post-tax return on capital, return on assets is EBIT 1 minus T. So earnings before interest and taxes. Earnings before interest and taxes need to be taken upon the assets. Now, how do you get the earnings before interest and taxes? This is your GP. From this GP, you reduce your operating expenses of 80,000. That will give you 1,60,000. This is your EBIT. How much return we are generating on the assets? For that, we take post-tax EBIT. EBIT as reduced by taxes. Because if I assume that suppose the entire EBIT was, the entire earnings that we have is attributable to our shareholders, so we take only that into consideration. EBIT 1 minus T upon the assets, that is 10%. Then asset turnover. Asset turnover is simply, as I told you, sales upon asset. Sales upon assets. We have the sales figure, and asset value is anyways 8 lakh given to us. It's 0.9. Return on owner's equity, that is return on owned funds. So this is the return that we have generated on owned funds. Owned funds is, again, we say out of 8 lakh, 50% was borrowed funds. The rest 50% will be owned funds. So it is 64,000 upon 4 lakh, that is 16%. Okay, so with that, your illustration 3 is also pretty simple. Let's go for illustration 4. Now, illustration 4 is ABC company selling Plumbing fixtures on terms of 2 by 10 net 30. Its financial statements over the last 3 years are as follows. Over the last 3 years, we have these figures 2018, 19, and 20. Cash, accounts receivable, inventory, net fixed assets, accounts payable, accruals, I can say, which we have to pay, accrued interest, and all such things. When tax rate is not given, can we assume it to be 50%? No, dear. You cannot just leave it as it is zero, unless and until question says don't assume any tax rate. Please take question 7 subpart C after this question. TYK question. Which TYK question? All. Is TYK. Practical questions are you talking about, for which one? Please let me know after this. Illustration 4. So 18, 19, 20, we have got 3 years balance sheet and some of the figures over here. Analyze the company's financial condition and performance over the last 3 years. Are there any problems? Now, to analyze the performance, I need to have some ratios. So those ratios are already calculated in the solution for you. You can verify them later on. Like current ratio, you will find current ratio is simply current asset divided by current liability. You can say it is current asset of 6 lakh 30 divided by say 6 lakh 30,000 divided by 6 lakh. This total is 6 lakh 30 divided by like 30,000. This is 1,000 divided by 1.19 is the ratio that we have. Test your knowledge question. Okay. Practical question, right? Question 7 or all these ratios are calculated for us. They are already there. Current ratio, asset test ratio, all these things are already there. So we're not concentrating on calculation of ratios. The focus is to analyze them. If I ask you what is the pattern of, we'll just try to just put up a pattern over here. Current ratio, it's like initially it is 1.19, then it has become 1.25, then it has become 1.2. So it is like there's no specific pattern in it. No specific. So it's like changing. Asset test ratio, again, it is changing. There isn't any pattern being identified. Average collection period will definitely see that it has risen. Average collection period over 3 years, you will find that it has increased. Inventory turnover has reduced. Inventory turnover has reduced. Let's first identify the pattern. Then we can talk about the comments on it. Total debt to net worth. Total debt to net worth. Total debt to net worth. So, like it has increased. Pattern is increasing range. Long-term debt to total capitalization. Long-term debt to total. Again, not much. It has more or less remained stagnant. Gross profit margin, yes, it has reduced some. Net profit margin, again, it has reduced. Asset turnover, it has reduced. Return on assets has also reduced. So I suppose you would have right now got some idea as to what is happening in the company. Ignoring this current asset and asset test, all those things. Average collection period is increasing, sir. It means I'm not able to collect money from my debtors on time as it was earlier. So inventory turnover is reducing. Inventory turnover is reducing. It means I'm not able to sell as many times as I was about to, as I was able to sell earlier. Total debt to net worth, total debt to net worth, it's like increasing. It means I'm having a higher and higher amount of debt. So I'm taking more and more loan. Long-term debt to total capitalization, no such trend identified. Gross profit margin is reducing. Net profit margin is reducing. Turnover is reducing. Return on assets is reducing. So we say there is some problem in the company, sir. Company is not able to generate returns. Company margins are reducing. Turnover is also reducing. Company is taking like more and more debt. You can say there is some problem with the company, sir. So company is not able to collect money from the debtors on time. Company is not able to sell the goods on time. Company is taking more and more debt. Moreover, the return on assets is also reducing. Slowly and steadily, I can say the company is not performing well, and that is where the analysis is also built around. Company's profitability has declined steadily over the period. That is what we have observed. As only 50,000 is added to the retained earnings, and the company must be paying substantial dividends. So over a period, you can also analyze the retained earnings, sir. Retained earnings as like 5 lakh to 5 lakh 50, no further increase. So possibly the company is like paying dividend or something like that, maybe. Uh, Receivables are growing slower, although the average collection period is still very reasonable related to the terms given. Now, to the terms given, what is this term? 2 by 10 net 30. 2 by 10 net 30 simply means that we are offering 2% discount to our debtors if they pay within 10 days. If the debtors are able to pay within 10 days, the debtors are able to pay within 10 days, then they'll be given a 2% discount. If they are not able to pay within 10 days, then obviously no discount will be offered to them and they will be paid like 30 days. So collection period, we observe that it is like up to 27, it goes up to like 27 days. So it is well within the range, but still the collection period is increasing. The company needs to be cautious about that. Inventory turnover is also slowing down, indicating that company is building up slowly and steadily a good amount, or I can say a good quantum of debtors or good quantum of stock. They are not getting increased. The increase in receivables inventory coupled with the fact that net worth has increased very little. So inventory and turnover, inventories and receivables have increased. So debt to net worth ratio is also increased. So at a higher level, current ratio, asset ratio have fluctuated, but the current ratio is not particularly inspiring. Don't get shocked by these words, sir. How do we get these very fancy words or such hyphen to level of English? But you will gradually develop that skill. So when they say that current ratio is like it's 1.19, 1.25, because we know current ratio, the standard is 2, which is not at par. Even the acid test ratio is low, because acid test ratio also should be like acid test or the quick ratio should be 1. So that is also below 1. It means the company is really facing some liquidity issue. Lack of deterioration in this ratio is clouded by relative buildup of both receivable and inventory. So since you're having both inventory and receivables higher, so you are having this stagnated value. Both the GP and net profit margins have declined substantially. The relationship between the two suggests that the company has reduced relative expenses in 2019 in particular. The buildup in inventory has resulted in decline in asset turnover ratio also. So the asset turnover ratio has also reduced because of you have that asset base increasing. And that has resulted in decrease in return on assets ratio also. What is common stock? Common stock is equity shares. What total debt to net worth? Total debt to net worth is simply debt equity ratio. It is simply debt equity ratio. Okay. Then illustration 5, we have again balance sheet given, statement of profitability given. How can we get an idea to take only these ratios? This is an illustrative thing, so don't get worried. You like Whatever ratios you can calculate from the given numbers, you should be calculating all of them. Okay, whatever ratios you can calculate, whatever ratios you can do uh, from these numbers, you should take up those ratios for discussion or for calculation purpose. Okay, there's a request. Shall we discuss some extra questions? Considering the timing constraint, um, would you like to, do you want me to discuss the questions, remaining questions, or shall we take up a extra question for discussion, like one more question, which will be not from the module? Like I was planning to give a couple of questions as homework. What is your take, guys? Shall we take up an additional question which should be different from the module, or shall we just discuss the module questions and you will try those couple of questions as homework? Let me know, guys. Maybe any specific question from module that you want me to discuss, that we can ideal time for completing questions like illustration 4. Ideal time for completing illustration 4. Um, Again, it should be done within, like if it's a 10 mark questions, you should be able to do within 20 to 25 minutes. Ratios and all the analysis, everything. Because whenever you're calculating ratios, you need not write down the formula, you have to just put in the numbers. Yeah, guys, I'm just waiting for your suggestions. Shall we take up an extra question, or shall we continue with some more illustrations from the module itself? Or any specific question of module that you want me to discuss? I'm okay with that also. For that, there was a request from for question number 7, I think, C part. Extra questions, additional questions. MCQ 14, different questions. Okay. MCQ 14, and anyone's, I think there was one person who asked me. So let me just do this two things. So we'll do question number 14. Question number 14 एक MCQ का request है, and that part C of question. Okay, fine, we'll take up where all of you are asking for different from modules. Okay, well, guys, I'll take up a question. Just let me quickly solve this question 14 also. Question number 14. It says calculate the operating expense from the following information. So operating expenses are like sales of 75 lakh, rate of income tax is 50%, cost of goods sold is 32 lakh 90,000, interest on debentures of 60,000. So which of these is a operating expense? The information given below. So let's say sales is 75. Step down numbers over here. Sales of 75 lakh less COGS, cost of goods sold is given as 32 lakh 90,000, less any operating expenses will give you a GP. Wait. COGS subtract, okay, you'll get GP. So GP of 75 minus 75 lakh minus 32 lakh 90. GP of 25 lakh 20,000. Okay. And then the question says that There's an interest on debentures of 60,000 and net profit is also given. So from GP, we reduce our operating expenses. Less operating expenses will give you operating profit. From that, you reduce the interest on debentures of 60,000. You will get a profit before tax. From that, you pay tax and you get PAT. Net profit to sales is given as 5%. Net profit to sales figure is given as 5%. So profit after tax will be definitely 75,000 into 5%. 75,000, 7,50,000. So 5% is 3,75,000. Get the profit after tax to be 3,75,000. Tax rate is given to us to be 50%. So this should be 100%. This will be 50%. This will be 50%. Definitely tax is going to be 3,75,000 and profit before tax will be 7,50,000. Okay, so just going fast reverse, 7,50,000 interest is 60,000. So our operating profit P is wrong over here. Or is it 75 lakh? Yes, 32 lakh 90,000. 25 lakh, 75 lakh minus 75 lakh minus 32 lakh 90. 42 lakh 10,000. Okay. 42 lakh 10,000. Okay, 3 lakh 75, 7 lakh 50, 100, 50, 50. Interest is this. So operating expense, operating profit and operating expense. You'll have to just go past. I mean, you'll have to go in a reverse way. In a reverse way, 7 lakh 50 and 60,000. So if I consider both of them, 7 lakh 50 and 60,000, our operating profit will work out to be 7 lakh 50 is after reducing 60,000. So ideally it should be, sir, 8 lakh 10,000. So ideally the operating profit should be 8 lakh 10,000. Okay. So operating profit is 8 lakh 10,000 and definitely we'll have the operating expense as a balancing figure over here, which is 34 lakh. 34 lakh is the operating profit. So option C is the correct one. What type of questions can come in exams from this chapter? You can have calculation of ratios, analysis of the ratios, and the other thing is you can they can ask you to prepare balance sheet and P&L. Okay, so I think question number 14 is clear to everyone. That was a request from your end. Now, your name is not there. The feedback form. I don't know. Whoever's name is there, you can just the feedback. No issues in that. I teaching style is amazing. Thank you very much. But feedback is secondary for me, guys. My whole point is that you getting the things in a more conceptual manner. Fine. Done question 14. Let me just bring. Let me just come up with an additional question which you can practice. Just give me some time. Just give me a minute. Just give me a minute, guys. Yeah, yeah. I'm there. I'm there. Just I'm just bringing the question. Okay. Mhm. Yeah. Is the screen visible now? Is it visible? Okay. Just I was getting this question on the screen. So let's look for a question. Question number one, we'll solve it. Question two, you can take it as homework for practice. I'll upload the solution for both on the portal itself. Based on the following information, prepare balance sheet of Stellar Limited as of 31st March. I've got a current ratio of 2.5, liquidity ratio of 1.5, net working capital of 6 lakh, stock turnover ratio of 5, gross profit to sales is 20%, COGS to net fixed asset ratio is 2, average debtors collection period is 2.4 months, fixed asset to net worth is 0.8, and long term debt to capital and reserves is 7 by 20. This is our ratio. These are the ratios given, and we have to prepare a balance sheet. Now, my suggestion would be for you that whenever you have this sort of preparation of balance sheet, what you should ideally do is, have an idea of a rough balance sheet in your mind, and then you just go ahead with it. With whatever information you get, you can just start solving it. Like for example, first we have the current ratio of 2:1, right? So current ratio, just so current ratio of 2:1 is given. So again, I'm solving it in a shorter way, so that you can get the flow. But in exams, please make sure you write the full forms. Don't use CR, CA, CL. Current ratio is given as 2.5, which should be ideally current asset upon current liability. So it means, therefore, sir, 2.5 times of current liability is current asset. 2.5 times of current liability is current asset. Sir, connected with this, we have another figure called as net working capital of 6 lakh. So net working capital, we say it is current asset minus current liability. Current asset is 2.5 times of current liability minus current liability, which is equal to 6 lakh. Right. So we have current asset minus current liability of 6 lakh. The 2.5 times of current liability minus current liability is equal to 6 lakh. So this is 6 lakh, and 1.5 times of current liability is 6 lakh. That will give us current liability figure of 6 lakh divided by 1.5. 6 lakh divided by 1.5. So current liability works out to be 4 lakh. Current liability works out to be 4 lakh. Now, based on this current liability of 4 lakh, we can also say, so since current asset was 2.5 times of current liability, is 2.5 times of 4 lakh. Which is 2.5 times of 4 lakh will give you the current asset figure as 10 lakh. Okay, great. We have got the values of current assets and current liabilities. Fine. Let us use some more figures for our calculation. There's this liquidity ratio, or it's actually liquid ratio. Liquid ratio or quick ratio, as we call it as. Liquid ratio is simply current asset as reduced by stock and prepaid expense. So like we did in the previous one, we ignore the prepaid expenses because we may say that a business is running without prepaid expenses. So current asset minus stock divided by current liability is 1.5. We have current asset figure of 10 lakh minus stock upon current liability is 1.5. We know the current liability also 4 lakh. We know the current liability also 4 lakh. So that is simply like 10 lakh minus stock is 1.5 times of 4 lakh. 1.5 times of 4 lakh, which is 6 lakh. So stock will be, and so rearrange it and you can get it as stock is 4 lakh. Right. Then net working capital done. Stock turnover is 5 and gross profit to sales is 20. So let us use this stock turnover ratio. First, we'll use all the ratios, all the numbers that we have, whatever possible. And then we will draw up a balance sheet roughly. And maybe if we'll see there is some balancing figure, we can think about that also. So let's say stock turnover. Stock turnover is 5 times. So the stock turnover is 5 times. That is simply computed. Stock turnover is simply computed 5 times as COGS upon average stock. So, but in question, there is no information of opening stock. So whatever is our closing stock, that itself will be our average stock. So stock of 5 times. So 5 is COGS upon, let's take the stock as same 4 lakh. So we get COGS figure as 20 lakh. We get a COGS figure as 20 lakhs. COGS, so stock turnover ratio is done. Then we have GP to sales. That is going to give us the value of GP and the sales, right? So GP ratio is given as 20. So obviously, sir, COGS ratio will be 80%. COGS will be 80%. So if COGS is 80%, therefore our sales is going to be 20 lakh COGS upon 80%. So our sales will work out to be 20 lakh is 80%. 20 lakh divided by 0.8, 25 lakh is our sales. We got a sales value of 25 lakh because there's a GP ratio, GP to sales, which is 20%. So ideally, the COGS that we get is our sales figure. COGS divided by 80. Fine. Now COGS is going to help us in understanding how much is our net fixed assets. So COGS to net fixed assets is given COGS upon fixed asset of 2. So COGS is 20 lakh divided by fixed asset. We don't know how much it is. So ideally fixed asset should be 10 lakh. Okay, we got another balance sheet figure, fixed asset. Then the next ratio is average debtors collection period is 2.4 months. Average debtors collection period is 2.4 months. We have debtors collection period of 2.4 months. How do we get this 2.4 months? It would have been 12 upon debtors turnover. So, sir, debtors turnover, it means is 12 divided by 2.4. So, it's 12 divided by 2.4. Then it is 5 times we get. Say the debtors turnover is 5 times. If you take inventory turnover as sales, then the answer is different, which is better. I told you in the beginning when I was explaining you the inventory turnover, the ideal is always COGS. If you have COGS information, use that. If COGS is not available, then you can go for the sales figure. So debtors collection, debtors turnover is 5 times, and we know that debtors turnover is computed as credit sales. Now there's no information again over here how much is credit and cash. So as I told you in the explanation, also in the ratio explanation, we said that if nothing is specified, you can assume all the sales are credit. So this is credit sales upon debtors figure. So this is 5 equal to credit sales. We don't know. We'll take entire sales upon the fact sales figure. We know sales is 25 lakh, 25 lakh, and the debtors is something which you have to find out. So debtors value will be 5 lakh for the debtors. Then next is fixed assets to net worth ratio is 0.8. Fixed assets to net worth, the ratio is 0.8. Fixed assets upon net worth. Fixed asset upon net worth is 0.8. So we have the fixed asset figure, which is 10 lakh. Fixed asset figure is 10 lakh upon net worth is something which we don't know. So definitely our net worth will be 10 lakh divided by 0.8. It's 10 lakh divided by 0.8. That's 12 lakh 50,000 is our net worth. What is ideally our net worth? We say it is equity share capital plus the reserves. Then the last ratio, we have long-term debt to capital and reserves. Long-term debt to capital and reserves. Long-term debt to capital and reserves. So capital and reserves is nothing but the same net worth. It is given as 7 by 25. So we don't have information of anything of long-term debt, but net worth we have 12 lakh 50,000. Long-term debt will work out to be 12 lakh 50,000 multiplied by 7 divided by 25. Long-term debt works out to be 3 lakh 50,000. We have used all the ratios. Once you have used all the ratios, just try to put it in the balance sheet and see if it's getting really tallied. In rough manner, I'm just going to prepare the balance sheet. So in balance sheet, we have the figure as net worth, which is equity share capital and reserves, which I also call it as equity shareholders funds. They also call it as like equity shareholders fund, which we have already computed it to be 12 lakh 50. Now the question is not giving me any further information as relation between the equity and reserves. It is not specifying how much of the total owned funds is equity and how much is reserves. So I'm going to write it as simply equity shareholders funds of 12 lakh 50,000. Liability side, we have like long-term debt of 3 lakh 50,000. Then on the asset side, we have got debtors of 5 lakh. Then we also got a fixed asset of 10 lakh. Let me just put that fixed asset of 10 lakh. What all things have others? We have computed COGS, but COGS is having no use on our balance sheet. Yeah, stock is there 4 lakh. You can say that we've got a stock of 4 lakh. Any other thing you have computed? We have also computed a current liability to be 4 lakh. Current liability of 4 lakh. Then we have net working capital current liability, current asset was 10 lakh. Total current assets. We had a total of current assets of 10 lakh. Current assets, total current assets should be 10 lakh. But is this really balancing out? Is this really getting balancing out? Like it is 5 lakh, 4 lakh, 1 lakh is the difference. So now what will be that 1 lakh? Definitely you can say cash and bank is going to be the balancing figure. This cash and bank is a balancing figure that we have. And once you have put up all the values, check for the total. Is it tallying? I think it is tallying because the numbers are like 20 lakh. And if you apply various ratios, and my suggestion for you would be that once you have prepared the balance sheet, once you've prepared the balance sheet after applying all the things, double check it. Just verify whether these ratios are getting satisfied in this. Just for surety. Quickly आप देख सकते हो. Like you can say current ratio of 2.5. Is it really 2.5? Current asset 10 lakh, current liability 4 lakh. Yes, sir, 2.5. Liquid ratio of 1.5. Sir, liquid asset is these two. 6 lakh divided by 4 lakh. Yes, sir, it is 1.5. Net working capital of 6 lakh. Yes, sir, 10 lakh minus 4 lakh. Stock turnover ratio is 5. That really helped us to get the value of stock. GP to sales, okay. COGS to sales, that I cannot verify. Average collection period of 2.4 months, that I cannot verify. Fixed asset to net worth, fixed asset to net worth, yes, it is 0.8. Long-term debt to capital and reserves, the ratio between these two, 7:25. Yes, it is. Right, so total 20 lakh, it should get tally. Just whenever you have such questions, the only tricky part over here is this balance sheet and P&L formation. This the tricky part is you need to go through this ratio. Whatever is possible, just calculate with the ratios. Then prepare a rough balance sheet. Prepare a rough balance sheet, and you will identify the ones which are left over or need to be calculated. Sometimes it will be just a balancing figure. Sometimes some manipulation may be required to be done. Okay, so question 1 is what we did. As of now, we don't have any time, or we don't have the time today to solve question 2. So I give question 2 as homework. I'll be uploading the solution for both, and also this entire thing that we have done today. I mean, right from all the ratios that we have done right from the beginning, with all the discussion, I'll be putting them on the portal. You can access it. By tomorrow, I think you will be able to access all the files that I'll be uploading. And I hope it was a fruitful session for you all. With regards to the ratio, some more insights I presume you have got about the ratios. How do we solve the questions? It will require gradually, if you more and more you solve, more and more you analyze the balance sheets and P&L, you will get used to this sort of thing. So with that, guys, let's just stop here for the day. Few queries of how many marks questions like this can come. This sort of questions you can have like ranging from 6 to 8 marks. You have 6 to 8 mark question. If it involves even a P&L preparation, like we had the illustration 2, it can definitely come for 8 to 10 marks also, depending on the severity and the length that is involved. Okay. I think we have answered all the queries. Yeah. So let's just stop here, everyone. I hope You enjoyed both the sessions for ratio with the compact timing. I have tried my best to explain the ratios conceptually to the best possible extent. I also have done certain questions to apply those questions. Um, let's just stop here, guys. We'll meet again in the next sessions. Just one query coming up. Why short-term loan not included in net working capital? Short-term loan is not included in net working capital because it's a borrowed fund. I think this was a question which was raised even in the previous session. So previous session I said the same thing. Short-term loan is a source of fund. So that needs to be, generally the short-term loans are, payable on demand. So it's a bank loan. So we consider it separately in the part of borrowings and not in the working capital. Many textbooks do take the short-term loans as a part of current liability, but in our module, we are not taking it. So be aware about that. Now, please tell the tips to remember all this formula. I will suggest you, not to by heart this formula. Try to remember them conceptually in the same flow which I have taken up. Anyway, this lecture will be available on YouTube, so you can review this. You can view this lecture again and again. Couple of times you view it again. Conceptually, you will remember the formula. You will definitely not, forget any of these formulas. Amazing. Thank you for amazing session. Okay. Thank you, everyone. Take up the export financing concept. Yes, I'll be taking up in the subsequent session. We'll have some more sessions, maybe the next month or so. Export financing, you can just give it a read. It's very easy, but still I'll cover that up in the next session. Thank you so much. Kindly request ICAI to add your name so that you can give the feedback. Surely I'll put it across. Thank you, guys. Let's just stop here for the day. Good night. Enjoy and take care. Are you offline? Yes, yes, we are done.